So Tuesday mornings in the trenches of tax season usually mean one thing.
Yeah, entirely too much coffee.
Right, entirely too much coffee. And that sudden jarring realization that a client has completely mismanaged their working capital because they just didn't understand tax accounting.
It happens every single year.
Every year. And that is exactly the energy we're bringing to you today. So pull up a chair, grab a mug, and let's get into the weeds.
We are going deep today.
We really are. We're taking a deep dive into the absolute friction between business reality and IRS reality, specifically looking at how the timing of advance payments dictates exactly when the federal government demands its cut.
It's the perfect subject for us to tear apart today because that disconnect between economic reality and tax liability is where businesses either thrive or they quietly bleed out.
Yeah, they just suffocate.
Exactly. We're looking at the mechanics of proposed regulations section 1.451-8 and how the Tax Cuts and Jobs Act aggressively rewired the board for accrual method taxpayers.
Which is huge.
It is. It's one of those areas of the code that looks straightforward on a summary sheet, but when you actually try to map the journal entries to a tax return, the complexity just explodes.
Oh, absolutely. And our guide through this labyrinth today is this phenomenal piece of technical writing from the tax advisor. It was published back in February 2020 by John Satora and Debbie Shee.
Yes, advance payments for goods and services. Great piece.
Right. Satora and Shee did a brilliant job dissecting the fallout of the TCJA on Section 451. And for you listening, whether you are managing a book of clients or running a corporate tax department or just trying to keep your own enterprise from suffocating under a preventable tax burden, understanding the nuances they laid out is just non-negotiable.
Completely non-negotiable. The central premise here really boils down to the concept of the ability to pay.
Okay, let's unpack this, because that's a loaded phrase for the IRS.
It is. The IRS operates from this historically entrenched position that if you have the cash in your treasury, you have the ability to pay the tax on it.
Regardless of whether you've actually done anything to earn that cash yet?
Exactly. Satora and Shee point this out right out of the gate when they discuss the general rule under Section 451. Gross income is included in the year of receipt unless your accounting method explicitly provides a shield.
And that shield is heavily contested territory. I mean, we all know the matching principle, right? It is the bedrock of accrual accounting.
You match the revenue to the period in which you incur the expenses to generate that revenue.
Right. It presents a true, accurate picture of profitability. But the IRS's all events test under regulations section 1.451H1 operates on a completely different frequency.
A completely different frequency. Under the standard accrual method for tax, you recognize income when all the events have occurred that fix your right to receive it, and the amount can be determined with reasonable accuracy.
And it's the triggers for fixing that right where the IRS sets the trap?
Yeah, the all events test is satisfied at the earliest of 3 milestones, when the payment is due, when the required performance takes place.
Or when the payment is actually made.
When the payment is made. That's the killer. What's fascinating here is the sheer brutality of the IRS's preferred method.
The full inclusion method.
Right, the full inclusion method under the amended Section 451C. TCJA basically codified the IRS's historical desire to tax cash the exact second it clears the bank.
If you get paid in advance, the payment is made, trigger is tripped. The all events test is met.
And the IRS looks at that cash and says, well, that's gross income for the current tax year. It's the classic IRS maneuver.
They are perfectly happy to ignore the matching principle if it accelerates revenue collection for the Treasury.
Completely happy to do it. From a pure financial accounting standpoint, an advance payment is a liability. It's unearned revenue.
Yes.
If I take $5 million from a client today for a massive software rollout that I'm executing next year, I don't have $5 million of revenue.
No, you have a $5 million debt.
I owe them the software or I owe them a refund.
I want to put some hard numbers to this because the working capital destruction of the full inclusion method is staggering if you aren't planning for it. Let's say you represent an engineering firm.
Okay.
It's November. They sign a massive, highly lucrative contract for an infrastructure project. The client remits a $10 million mobilization payment on December 1st.
A huge influx of cash.
Right. But the actual engineering work, the hiring of the heavy contractors, the procurement of materials, none of that begins until March of the following year.
So on December 31st, their balance sheet shows a $10 million bump in cash offset by a $10 million deferred revenue liability.
Exactly. From an economic perspective, they haven't recognized a single dime of profit. Their EBITDA on that project is literally zero.
But then the tax department runs the numbers under strict full inclusion.
And the payment was made in December.
Right. So the all events test is met for that entire $10 million. It all drops into taxable gross income for that year.
Let's assume a blended 25% effective tax rate between federal and state. Suddenly, this firm owes $2.5 million in hard cash to the tax authorities on April 15th.
Generated entirely by a project that hasn't incurred a single dollar of deductible expenses yet.
And this is exactly where the liquidity crunch hits. They took the $10 million to fund the project.
Right. If the profit margin on the infrastructure build was modeled at, say, 15%, they were expecting $1.5 million in total profit over the life of the contract.
Meaning they need $8.5 million of that initial cash to actually pay the vendors and the engineers.
But they just had to wire $2.5 million to the IRS. They only have $7.5 million left in the bank. They are immediately underwater.
They have to tap into a credit line paying interest just to finance the timing difference of their tax liability. It is wild how you can literally grow yourself into a liquidity crisis.
It really is. If you are a rapidly scaling enterprise taking massive pre-orders or retainers, your tax bill will outpace your actual economic margins.
It aggressively strangles your ability to operate.
And that liquidity crunch is exactly why the IRS couldn't just leave full inclusion as the only option. They had to throw accountants a bone.
Which is where the one-year deferral comes into play. Satora and Shi spend the bulk of their analysis in the tax advisor piece, dissecting this lifeline.
The deferral method under Section 451C is absolutely critical. What Congress did with the TCJA was take Revenue Procedure 2004-34, which practitioners had relied on for years, and they baked it directly into the statutory code.
It was a beloved revenue procedure because it offered a pragmatic truce between the IRS's desire for immediate taxation and the taxpayer's need to survive an advance payment.
Yeah, but looking closely at the codified deferral under 451C and the subsequent proposed regulations, it feels like they took RevProc 2004-34, pasted it into the code, but tightened the screws on the compliance side.
They really did. The mechanics dictate that you can elect to defer the inclusion of certain advance payments, but only to the subsequent tax year of receipt.
Right, and the golden rule is that the income must also be deferred for financial statement purposes. That's the vital linkage.
Whatever portion of the advance payment you leave sitting in your deferred revenue liability account on your financial books at the end of year one, you can defer for tax purposes.
But, and this is the absolutely hard stop, only until year two. The statute specifically uses the phrase, the next succeeding tax year.
And that phrasing leaves absolutely zero room for interpretation. If you collect a $3 million upfront payment in 2024 for a 5-year licensing agreement, you can defer the unearned portion into 2025.
Right. But you cannot defer it into 2026 or 2027 or 2028, regardless of how you amortize that revenue on your GAAP financials.
Come the end of 2025, the IRS expects you to recognize every remaining dollar of that advance payment, even if you still have 3 years left on the contract to service.
The IRS is striking a very deliberate balance here. They are acknowledging that taxing advance payments immediately can cripple working capital.
Right.
But they refuse to let businesses sit on untaxed cash reserves for half a decade just because the contract duration is stretched.
The 1-year limit solves the immediate December to February year-end cash flow crisis we talked about earlier with the engineering firm. But it ensures the Treasury gets made whole relatively quickly.
So let's talk about what actually qualifies for this treatment, because the proposed regulations do not offer a blanket amnesty for all cash receipts.
Satora and Shi list the eligible revenue types, and it's a fairly broad spectrum of the modern economy.
You've got payments for goods, services, the use of intellectual property.
Which is massive for the tech sector.
Massive. Software gift cards, eligible subscriptions, certain warranty contracts, memberships and reward or loyalty programs.
It covers almost any standard commercial transaction where performance is delayed. But here's where it gets really interesting and dangerous.
Oh yeah, the hidden landmines.
Satora and Shi highlight this, and it's something every tax director needs permanently etched into their brain. The cost of goods sold trap.
Let's unpack the KJS trap thoroughly, because this is where the 1-year deferral limit completely fractures the matching principle, and the math just gets incredibly ugly.
The preamble to the proposed regulations explicitly points out that these advance payment provisions operate strictly at the gross receipts level.
They are entirely focused on the timing of revenue recognition. There is no corresponding offset rule for the cost of goods sold.
The asymmetry here is brutal. Because you have that strict 1-year limit on the tax deferral, a taxpayer is frequently forced to recognize the remainder of an advance payment in year 2.
But under standard tax accounting rules, if they haven't actually delivered the physical goods or incurred the hard costs by the end of year 2, they haven't technically incurred the cost of goods sold.
So they have to recognize 100% of the gross revenue in year 2, but they might not be legally allowed to deduct the expenses to generate that revenue until year 3 or year 4.
Let's run a granular scenario on this because seeing the journal entries translate to the tax return is where the pain really becomes visible.
Let's look at a high-end luxury retailer, or maybe a specialty manufacturer that sells long-term bundled packages. Let's say they sell a premium custom-built outdoor kitchen bundle.
Great example.
The customer pays $100,000 in cash in November of year 1. The contract says the company will custom manufacture the appliances and install them, but due to supply chain backlogs, delivery isn't guaranteed until May of year 3.
Okay, let's track the cash and the tax. Year 1 November, they receive $100,000 cash. No performance has occurred.
Right.
Under the Section 451C deferral method, they look at their financial statements at year end. The full $100,000 is sitting in deferred revenue.
So for tax purposes, they defer the entire amount. 0 taxable income in year 1.
The lifeline worked exactly as intended.
The tax director breathes a sigh of relief. But then we roll into year 2. The supply chain is still locked up. The company is designing the kitchen, but they haven't taken delivery of the heavy materials. They haven't paid the installation crews.
Financially on their GAAP books, that $100,000 is still sitting squarely in the liability column as deferred revenue.
But the tax code doesn't care about their GAAP books anymore. The 451C lifeline has an expiration date.
The next succeeding tax year, year 2, is that year.
Therefore, on December 31st of year 2, the tax regulations force an acceleration. The company must pull that entire $100,000 into taxable gross income.
So they recognize $100,000 of gross income. Now, normally, if you recognize revenue on a physical good, you deduct the COGS.
Let's say the materials and labor for this kitchen cost $70,000. Their true economic profit is $30,000.
But in year 2, because they haven't actually built and delivered the kitchen, they haven't met the requirements to deduct that $70,000 under the tax accounting rules for inventory and COGS.
Exactly. So in year 2, they pay corporate income tax on a phantom $100,000 profit.
If they're at a 25% rate, they're writing a $25,000 check to the IRS.
Then year 3 finally rolls around, May arrives, they receive the materials, they send out the crews, they install the kitchen, the customer's happy. In year 3, they finally get to deduct their $70,000 cost of goods sold.
But they have no corresponding revenue in year 3 to offset it against because they already paid tax on it in year 2.
So in year 3, they generate a massive $70,000 artificial tax loss on this specific project.
This creates a wildly distorted seesaw effect on their taxable income. They artificially inflated their taxable income in year 2, paying taxes well before the economic profit was realized, and then artificially depressed their taxable income in year 3.
And this isn't just a timing inconvenience. There is a real measurable cost here. The time value of money.
Let's stop right there and quantify that, because the time value of money is the silent killer in tax accounting.
By forcing the company to pay $25,000 in tax in year 2 instead of year 3, when the project is actually completed, the IRS has effectively taken a $25,000 interest-free loan from the taxpayer for a full 12 months.
If that company's cost of capital is 8%, meaning they could have invested that cash in their business or used it to pay down an 8% credit line, that one-year timing mismatch just cost them $2,000 in hard, unrecoverable cash.
Multiply that $2,000 drag across a company doing $50 or $100 million in advance orders, and you're looking at hundreds of thousands of dollars in lost working capital efficiency.
Purely because the tax code refuses to allow a COGS offset to match the forced revenue inclusion. Taxpayers have to model this out meticulously.
You have to. If you are electing the deferral method, you have to project your expected delivery dates, because if they bleed past year 2, you are walking straight into the COGS trap.
And navigating this entire minefield requires a fundamental understanding of how your tax reporting interacts with your financial reporting.
You can't even play the deferral game effectively if you don't understand the rules of the applicable financial statement or the AFS.
This brings us to what I consider the most fascinating part of Satora and Shee's analysis. This is where Wall Street accounting standards collide head-on with IRS enforcement.
It is a phenomenal intersection. The proposed regulations, specifically Prop Reg Sec 1.451-8, are heavily tethered to another set of concurrently issued regulations, Prop Reg Sec 1.451-3, which define the AFS.
For most mid-market and enterprise companies, an AFS is your audited financial statement. prepared under generally accepted accounting principles that you provide to the SEC or a lending institution or your equity partners.
It is the gold standard of financial truth for the capital markets.
And the IRS, in a rare moment of leveraging external efficiency, essentially decided to piggyback on the rigorous audit standards required to produce a GAAP AFS.
The general rule is if you defer it on your audited financials, we will let you defer it for tax subject to the 1-year limit, of course.
But this linkage became incredibly profound because of a seismic shift that occurred over at the Financial Accounting Standards Board, FASB.
Right. Satora and she dive into the impact of FASB Accounting Standards Codification Topic 606, revenue from contracts with customers.
For anyone who lived through the implementation of Topic 606 a few years ago, it was a multi-year, multi-million-dollar compliance nightmare for corporate accounting departments.
It completely upended how companies allocate transaction prices and recognize revenue.
Topic 606 moved everything away from a rules-based approach to a principles-based approach centered on performance obligations.
And the proposed tax regulations explicitly acknowledge this new GAAP reality. They note that advance payments for things like loyalty points rewards programs, discount vouchers, and airline miles arrangements that Topic 606 forces companies to treat as entirely separate performance obligations may now be eligible for tax deferral under Section 451C.
If we connect this to the bigger picture, the historical context here is crucial to understand just how massive of a windfall this is for certain industries.
Before Topic 606 became the law of the land for GAAP, how did a company handle a loyalty program?
Let's say a hotel chain. A guest pays $500 for a room and earns 5,000 loyalty points. Under the old GAAP rules, the hotel would generally recognize the entire 500 as revenue immediately.
Right.
And they would simultaneously record a small estimated liability and accrued expense for the future cost of providing a free room when those points were eventually redeemed.
And from a tax perspective, under the old rules, accrued expenses for future contingent liabilities are generally not deductible until the all events test for the expense is met, meaning the guest actually redeems the points.
So the hotel recognized $500 of taxable revenue on day one and couldn't take the deduction for the loyalty points until years later. It was a terrible tax answer.
But then Topic 606 changed the financial accounting paradigm. FASB looked at that transaction and said, no, the guest isn't just buying a room.
The guest is buying two distinct things. They're buying a room tonight, and they're buying a voucher for a future room. The loyalty points are a separate performance obligation.
This is where the accounting gymnastics get really elegant. Topic 606 requires the hotel to look at that $500 transaction price and allocate it between the room and the points based on their relative standalone selling prices.
Let's say the room is valued at $480 and the points are valued at $20.
So on their audited AFS, the hotel recognizes $480 of revenue for the stay, that remaining $20. It goes onto the balance sheet as deferred revenue.
It is unearned. They haven't fulfilled the performance obligation of honoring those points yet.
And here is the punchline that Satora and she highlight. Because that $20 is now treated as deferred revenue on the AFS rather than an accrued expense, it suddenly becomes eligible for the Section 451C tax deferral.
The tax code follows the AFS, so the hotel now defers paying corporate tax on that $20 until the next succeeding tax year.
Think about the scale of this for the airline industry. Satora and she specifically mention airline miles. Airlines issue billions of dollars worth of frequent flyer miles every single year.
Not just to passengers, but selling them to credit card companies.
By shifting the characterization of those miles from an estimated future expense to a deferred revenue performance obligation under Topic 606, they unlocked the ability to defer the tax on billions of dollars of cash receipts for a full year.
It's an astronomical working capital advantage. If an airline can defer recognizing $1 billion of revenue from year one to year two at a 21% corporate tax rate, they are effectively holding on to $210 million in cash for an extra 12 months.
That is cash they can use to service debt fund aircraft acquisitions or aggressively price routes. It is a brilliant example of how hyper-technical financial accounting standards directly dictate macro-level tax strategy.
But of course, the IRS couldn't just write a rule that only benefited Fortune 500 companies with Big Four audited financials.
Right. What happens to the mid-market? What happens to the thriving manufacturing firm or the regional SaaS provider that does $30 million a year in revenue, but only gets a standard review or compilation from their local CPA firm rather than a full GAAP audit?
That is the non-AFS nuance. And Satora and she spent a good amount of ink breaking this down because originally things looked Exceptionally grim for Main Street.
When the TCJA was first drafted, the statutory language for the 451c deferral seemed heavily restricted to taxpayers who actually had an applicable financial statement.
If you didn't have an AFS, the implication was that you were thrown to the wolves of full inclusion. You had to pay tax on everything immediately.
It would have been wildly punitive. It would have meant that two businesses engaging in the exact same economic transactions would face drastically different tax burdens simply because one paid $100,000 for a GAAP audit and the other didn't.
Thankfully, the proposed regulations stepped in to provide a massive structural correction. Prop Regs, Section 1.451.8, allows taxpayers without an AFS to utilize the one-year deferral method.
But the mechanics of how they do it have to be different. A non-AFS taxpayer can't just point to their deferred revenue balance on an audited statement because that statement doesn't exist.
So the regulations introduce what they call the earned standard.
The earned standard. It's a clever bit of regulatory engineering.
It dictates that for tax deferral purposes, an advance payment is considered earned when the all-events test is met. But, and this is the crucial modifier analyzed without regard to when the amount is received.
Let me translate that out of IRS speak for you. Earlier, we established that the all-events test is met when payment is due, when performance takes place, or when payment is made. If a non-AFS taxpayer didn't ignore the payment is made trigger, then every single advance payment would meet the test instantly upon receipt, and they could never defer anything.
The deferral would be mathematically impossible. So the IRS says, okay, pretend you haven't received the cash yet. Based strictly on the contract and your performance, how much of this revenue have you actually earned this year?
The non-AFS taxpayer must include the advance payment in gross income in the year of receipt to the extent that it is earned under this modified test.
The remaining unearned portion is then deferred to the next succeeding tax year.
And practically, how does a mid-sized company calculate that if they don't have a massive ERP system tracking every micro deliverable?
Satora and Shi outline the allowable methods. If a business can't perfectly track the exact extent to which a payment is earned on a granular level, the regulations throw them a few pragmatic lifelines.
The first is a statistical basis. If the taxpayer has adequate historical data, they can use statistical modeling to determine when advance payments are typically earned.
This is highly useful for companies dealing with massive volumes of small transactions like prepaid service cards or minor warranties.
But the most common and arguably the most useful method for the mid-market is the straight-line ratable basis for fixed-term agreements.
Right. If you receive an advance payment under a fixed-term agreement, let's say a standard one-year maintenance contract, you can just recognize the income evenly over the term of the agreement, provided it's reasonable to assume the services will be performed roughly evenly.
Let's put some numbers to the straight-line non-AFS method. Let's say you run a regional IT managed services provider. You don't have an AFS.
Okay.
On October 1st, you sign a client to a 12-month, $120,000 prepaid support contract. They wire you the $120,000 on day one.
Under the non-AFS earned standard using the straight-line method, it's remarkably clean. The $120,000 is spread evenly over 12 months, so that's $10,000 a month of earned revenue.
In year one, you perform services in October, November, and December. That's 3 months. So you recognize $30,000 of the advance payment as taxable income in year one.
And the remaining $90,000 is deferred to year two. And because of the strict one-year limit, the entirety of that $90,000 must be recognized in year two, regardless of whether the contract happens to get extended or delayed.
It provides parity. The mid-market IT firm gets the exact same working capital deferral benefit as the massive enterprise software company with the audited financials.
As a final catch-all, the regulations state that a non-AFS taxpayer can use any other basis that results in a clear reflection of income, provided the commissioner agrees with it.
It gives tax practitioners the flexibility to argue for industry-specific recognition methods as long as they aren't wildly aggressive.
Okay, we've built the structure. We understand the core conflict. We've mathematically mapped out the deferral lifeline and the CODS trap.
And we've explored how GAAP AFS rules and the non-AFS earned standard dictate the flow.
Now, as any experienced CPA knows, it's time to look at the exclusions. Because the IRS never gives you a blanket deferral without carving out exceptions for the things they really want to tax right now.
Let's dive into the fine print: exceptions, exclusions, and acceleration.
The proposed regulations list specific types of advance payments that are absolutely dead on arrival when it comes to deferral.
Yeah.
If you receive these payments, you are in full inclusion territory. End of story.
The most notable exclusions are rent insurance premiums, payments with respect to financial instruments, and payments relating to certain warranty or guarantee contracts.
Let's focus on rent because this trips up commercial real estate developers constantly.
It really does. A client buys a strip mall, signs a massive anchor tenant, and collects the first year's rent, the last year's rent, and a hefty security deposit that can be applied to rent.
They come to you in January and say, great news, we got $500,000 in advance, rent, defer that to next year.
And you have to look them in the eye and tell them they owe tax on it today. So what does this all mean? Why is rent strictly excluded from the 451c lifeline?
The logic goes back decades in tax case law. It hinges on the nature of the transaction. Rent is fundamentally passive income. It is derived from the mere passage of time.
A landlord isn't actively performing a service or manufacturing a widget or deploying labor to earn that rent. They are simply allowing someone to occupy space.
The IRS has successfully argued, and the courts have repeatedly agreed, that advance rent gives the landlord immediate unrestricted use of the cash.
Since there is no active, costly performance required to fulfill the obligation, there is no economic justification for deferring the tax. The ability to pay is absolute and immediate.
It's a stark contrast to the outdoor kitchen example we used earlier, where the manufacturer has to actively source materials, deploy labor, and incur massive hard costs to fulfill their end of the bargain.
With rent, the asset just sits there. The same logic broadly applies to insurance premiums and financial instruments. They operate on capital and time, not active physical performance.
But Satora and Shi point out another exception in the regulations that is wildly interesting, and it operates in the exact opposite direction. It's not a punitive exclusion that accelerates tax. It's a protective carve-out for massive long-tail projects.
This is the specified goods exclusion, and it is a critical piece of the puzzle for heavy industry. This exclusion wasn't as explicitly defined in the older Rev Proc 2004 34 days, so its inclusion in the proposed regulations was a major talking point.
The rule states that an advance payment is excluded from the definition of an advance payment, and therefore excluded from the strict one-year deferral limit, if it is received more than one tax year before the tax year of the contractual delivery date for a specified good.
We need to define specified good carefully because clients will try to drive a truck through this loophole if you let them.
A specified good must meet two highly restrictive conditions. First, the taxpayer cannot have the particular good or a substantially similar good on hand at the end of the year the advance payment is received.
Right. If you have a warehouse full of standard industrial generators and a client prepays for one to be delivered in 3 years, that is not a specified good. You have it on hand. The intent here is to protect custom manufacturing.
And the second condition cements that intent. The taxpayer must recognize all of the revenue from the sale of that good in its AFS in the year of delivery.
So we're talking about massive multi-year bespoke manufacturing contracts. Satora and Sheen note that originally the industry assumed this was a narrow carve-out lobbied for by the aerospace and defense sectors.
But a close reading shows it applies much more broadly. Let's look at how this saves a company from the one-year deferral trap.
Let's use an aerospace manufacturer. Let's call them Apex Dynamics. They sign a contract with a global telecom conglomerate to design and build a custom next-generation communications satellite.
Okay.
The total contract is $200 million. In 2024, the telecom company wires a $50 million advance payment to fund the extreme R&D and specialized material procurement. But the contract specifically dictates that the satellite will not be completed, launched, and delivered until late 2027.
Let's analyze this under the standard rules first. Apex receives $50 million in 2024. If this were a standard advance payment subject to the 451c one-year deferral, they would defer the $50 million on their 2024 tax return.
But then the absolute strictness of the next succeeding tax year rule kicks in. In 2025, they would be legally forced to recognize the entire $50 million as taxable income.
Which would be an unmitigated disaster. It's 2025. They are in the absolute thick of engineering and testing. They haven't delivered anything. They haven't recognized a single dollar of revenue on their GAAP financials because GAAP dictates they recognize it upon delivery in 2027.
And they certainly haven't incurred the bulk of their deductible COGS yet. If the IRS demanded corporate tax on $50 million in 2025, it would utterly destroy the project's financing model.
They would be paying tens of millions in taxes on a satellite that is still a pile of titanium parts in a clean room.
Exactly. The one-year limit, which is meant to be a lifeline for short-term timing differences, becomes a lethal weapon when applied to a 4-year manufacturing cycle.
And that is why the specified goods exclusion is so vital, because the $50 million payment in 2024 is received more than one tax year prior to the 2027 delivery date. And because the satellite meets the strict definition of a specified good, the payment is entirely exempted from the 451(c) rules we've been discussing.
It gets shunted away from the one-year rule and is generally dealt with under other highly specialized accounting methods for long-term contracts, like Section 460, which do a much better job of aligning the tax recognition with the percentage of completion or the ultimate delivery.
It's a phenomenal safety valve. It proves that occasionally the Treasury Department does actually consult with heavy industry before finalizing regulations.
But even with all these rules, lifelines, and exclusions, things go wrong. Businesses are acquired, companies go bankrupt, and contracts are terminated.
Satora and Shi dedicated a critical section of their analysis to the acceleration rules. What happens when a taxpayer is sitting on deferred revenue and the music suddenly stops? When does a taxpayer lose the privilege of the one-year deferral and have to take the income immediately?
The proposed regulations basically ported over the old acceleration provisions from Rev Proc 2004-34. The clear-cut rules are pretty intuitive. You are forced to take any previously unrecognized deferred advance payments into taxable income immediately in the tax year in which the taxpayer either dies or ceases to exist in a transaction.
There are some technical exceptions there for certain corporate reorganizations, like a Section 381 transaction or certain Section 351 transfers, where the acquiring entity or the new subsidiary essentially steps into the shoes of the old company and adopts the same deferral method.
But generally speaking, if the legal entity liquidates and closes up shop, the deferral game ends. The IRS wants to make sure that deferred revenue doesn't just evaporate into the ether. It gets captured on the final terminal tax return.
That part is clean. If the taxpayer ceases to exist, accelerate the income. But the other trigger for acceleration is where Satora and Shiu planted a massive red flag.
The rule states that if the taxpayer's obligation with respect to the advance payments is satisfied or otherwise ends, the related income must be accelerated into the current year.
Otherwise ends. It sounds like innocuous regulatory boilerplate, but in practice, it is a gaping hole of ambiguity. When exactly does a business obligation end?
Satora and Shi use an incredibly relatable example to illustrate the danger here.
The washing machine manufacturer. Let's walk through this because this is the kind of subjective gray area where IRS revenue agents make their money during audits.
Let's say a manufacturer sells a high-end washing machine. The customer pays the machine is shipped installed and it's running in the customer's laundry room. The initial transaction of selling the physical good is completely finished.
If you ask a layperson, the manufacturer's obligation has ended. They delivered the machine. But any CPA looking at the holistic contract knows that isn't true.
The manufacturer may still be legally obligated to accept returns within a 90-day window. They are almost certainly obligated to service a standard one-year parts and labor warranty.
If the Consumer Product Safety Commission finds a defect, they are obligated to issue a recall and repair it. They might even have an obligation to process a mail-in rebate that the customer hasn't submitted yet.
So the ambiguity is massive. Does the manufacturer's obligation end at the exact moment the washing machine is delivered to the home? If so, any deferred revenue related to that specific sale, perhaps a portion allocated to a bundled installation service that got delayed, is instantly accelerated and taxed.
Or does the obligation only truly end when the 90-day return window closes? Or does it end when the 12-month warranty finally expires? Satora and Shi explicitly call out the fact that the proposed regulations fail to provide clear guidance on this point.
And without clear guidance, taxpayers are left playing defense. If a company takes the position that the obligation continues until the warranty expires, allowing them to stretch their deferral to the absolute maximum of the one-year limit, an aggressive IRS auditor could easily come in and argue against it.
They could argue, no, the primary obligation ended upon delivery. You should have accelerated that income in Q3, not Q4. You owe us underpayment penalties and interest.
It forces tax directors to make highly subjective judgment calls on contract law just to file a return.
It is the absolute definition of audit risk. Before we wrap up the technical deep dive, there is one more structural rule, Satora and Shi cover, that is actually a rare breath of fresh air.
It's highly technical, but it's an incredibly taxpayer-friendly accommodation, the short tax year rule.
Yes, the 92-day rule. This comes into play constantly during M&A activity or when a company changes its fiscal accounting period. Let's set the stage. A company receives an advance payment in year one. They elect the 451(c) deferral method, pushing the unearned revenue into year two.
Under normal circumstances, they have a full 12 months in year 2 to recognize that revenue, incur the related expenses, and smooth out their tax liability.
But what if year 2 isn't a full 12 months? Let's say the company is acquired by a larger conglomerate in early March of year 2. Because of the acquisition, they have to close their books and file a short period tax return for January 1st through March 2nd, a period of, say, 60 days.
Under a strict, merciless reading of the next succeeding tax year rule, that 60-day short period is the next succeeding tax year.
Which means the company would be legally forced to take 12 months' worth of deferred revenue from year 1 and violently cram it all into a tiny 60-day tax window.
The distortion that would cause to their taxable income would be catastrophic. You'd have massive revenue recognition with almost no time to incur the offsetting operational expenses. It would artificially spike their tax liability right at the moment of an acquisition.
But the proposed regulations retained a protective carve-out. The short tax year rule states that if a taxpayer is using the deferral method, and they have a short tax year consisting of 92 days or less in the year after receiving the advance payment, they are spared from the acceleration trap.
They do not have to pull all the remaining deferred revenue into that short 60-day year. Instead, they only have to include the portion of the advance payment in taxable income to the extent it was actually recognized in their applicable financial statement during those specific 60 days.
It's beautifully pragmatic. If they only recognize 15% of the revenue on their GAAP books during January and February, they only pay tax on that 15% in the short period return.
The remaining 85% continues to be deferred, rolling smoothly into the new full tax year of the acquiring consolidated group. It's one of the few areas where the IRS looked at the mechanics of corporate restructuring and said, okay, we won't penalize you for the calendar.
It really is an elegant solution. But taking a step back from the weeds of the 92-day rules and the COGS traps, we have to look at the macro picture. We have dissected the core conflict between the all events test and full inclusion.
We've charted the strict parameters of the one-year deferral lifeline, the outsized impact of GAAP AFS reporting under Topic 606, and the rigid exclusions for passive income like rent.
Let's distill this down for the listener, because understanding the mechanics is one thing, but applying it strategically is where you earn your fee.
The core unassailable takeaway from Satora and Shee's analysis is that managing advance payments is no longer just a bookkeeping exercise. It is an aggressive, proactive treasury function.
The timing difference between when cash hits your bank account and when you are forced to recognize it as taxable income can fundamentally alter your liquidity profile.
You absolutely cannot treat an advance payment as free cash flow. It is cash that is actively carrying a contingent tax liability.
If you default to the full inclusion method, you are voluntarily prepaying your taxes, sacrificing your working capital, and essentially funding the Treasury Department interest-free. The one-year deferral under Section 451C is your primary defense mechanism, but it requires surgical precision to execute.
Surgical is the right word, because if you blindly elect the deferral without modeling out your supply chain and your delivery timelines, you will walk your clients straight into the cost of goods sold trap.
Deferring revenue into year 2 does you no good if your physical costs don't trigger until year 3. You'll just be paying tax on a phantom gross margin.
And strategically, tax departments need to be in constant obsessive communication with their financial accounting counterparts. As Satora and She illuminated so clearly, the adoption of FASB Topic 606 was a watershed moment.
If your GAAP team is suddenly carving out loyalty programs, gift card breakage, or software implementation phases as separate performance obligations to appease the auditors, your tax team needs to instantly recognize that as a new tax deferral opportunity.
It's the ultimate synergy. The very accounting standard that made GAAP reporting a nightmare is the exact standard that can save you millions in accelerated tax payments.
But as we wrap up this deep dive, I want to pull on that thread just a little bit harder because there's a philosophical implication here that borders on the absurd.
We've spent the last hour detailing how intensely the tax code, specifically Section 451C, has lashed itself to the mast of the applicable financial statement. If you defer it on the AFS, you can defer it for tax.
Right, and who writes the rules for the AFS? It's not Congress, it's not the Treasury, it's not the IRS, it is the Financial Accounting Standards Board, FASB, which raises an incredibly provocative question. If eligibility for deferring billions of dollars in corporate taxes on things like airline miles or software subscriptions is now directly dictated by FASB's Topic 606 reporting standards, who is actually writing United States tax policy?
Has the IRS effectively, perhaps inadvertently, outsourced the regulation of corporate tax timing to a private, independent accounting board?
It's staggering when you think about it. FASB is a non-governmental nonprofit organization located in Connecticut. Their entire mandate is to write accounting rules that make financial statements useful, transparent, and comparable for investors and creditors.
They don't care about the federal budget deficit. They aren't mandated to protect the U.S. Treasury's revenue stream.
Exactly. When FASB spent years drafting Topic 606, and they decided that an airline loyalty mile was a separate performance obligation that had to be deferred on the balance sheet, their only goal was to stop airlines from overstating their immediate revenue to Wall Street.
They were trying to protect shareholders from artificially inflated earnings.
They weren't sitting around a conference table saying, you know what we should do? We should hand the global airline industry a multi-billion-dollar, one-year rolling tax deferral.
But because Section 451C inextricably links the tax treatment to the AFS treatment, FASB inadvertently draft one of the most significant pieces of corporate tax relief of the last decade.
It creates a fascinating, almost dangerous feedback loop. It fundamentally changes the calculus for a CFO or a corporate controller. In the past, if FASB proposed a new accounting rule, a company would analyze how it impacted their debt covenants or their earnings per share.
Now, they have to immediately run a tax model. A subtle tweak by FASB to make a balance sheet look more conservative to a commercial bank could inadvertently accelerate a massive tax liability with the IRS.
Or conversely, aggressive financial engineering to defer revenue for GAAP purposes now yields a massive immediate cash tax benefit. It completely blurs the lines between public tax policy and private financial reporting standards.
It means that the rules you use to impress your lenders are now aggressively dictating what you owe the federal government.
It's a dynamic that requires tax professionals to be just as fluent in GAAP principles as they are in the Internal Revenue Code. You can't operate in a vacuum anymore. Sator and Shi laid out the blueprint, but it's up to practitioners to actually build the bridge between the two disciplines.
Well, on that slightly terrifying, highly cynical note, we're going to drain the rest of this coffee and wrap up.
Yeah.
Thank you so much for joining us on this deep dive into the hidden, complex, and sometimes contradictory machinery of tax accounting.
It is a dense, unapologetically technical area of the law. But mastering the friction between advance payments, full inclusion, and AFS deferrals is how you protect a business's ultimate lifeblood, its cash flow.
Keep an eye on your balance sheet question, every GAAP adjustment, and we will catch you on the next deep dive.